Shadow of Truth, and today is Thursday, December the 22nd, 2016, and your hosts are Dave Kranzler from InvestmentResearchDynamics.com and Rory Hall from thedailycoin.org. What's up, Dave?
Well, not the stock market. Stock market's starting to point down.
Yay!
Gold keeps bouncing back from all the overnight smashes that it's been inflicted on it for the past several weeks. And I have a sneaking suspicion we might be talking about gold today.
We're going to be talking about gold and the Shanghai Gold Exchange rising premium, among other things gold related. So let's jump in.
Sounds good to me.
I know you've got a lot of gold on your mind.
Well, I was looking at a lot of data and writing up this latest issue of the Mining Stock Journal, and there are several indicators screaming buy about as loudly as I've ever seen a buy signal in the 15 years I've been doing this market.
Wow.
Yeah.
That's pretty cool.
Yeah. So
what are these indicators? What are these indicators pointing at?
They're technical indicators. Some of them are contrarian indicators. So, for instance, I was chatting with Eric King the other day, and I was asking his thought on the market, and because I said, it looks like just watching the intraday action. Every time they try to take silver below 16, it bounces back. Every time they try to get gold below 1130, it bounces back. And that's been kind of the case now for at least a week. And he said, if gold closes down this week, it'll be the first time that he can recall ever that it's closed down 7 weeks in a row on a weekly basis. And I went and I looked at a graph. The easy graph for me was GLD, and it goes back to late 2004. And there were two periods in 2008 when gold was down 5 weeks in a row, but there's not been any period going back to at least 2004 when gold was down more than 5 weeks in a row. So, and if it closes this week down, it'll be 7 weeks in a row. I think even 6 weeks in a row might be unprecedented.
That's what I was going to say. I mean,
yeah.
You can only find 5, and we're already at 6.
Right. And I mean, again, it's, at least as I watch the intraday activity, the takedown is only occurring, or for the most part, probably 70 to 80% of the time, during the paper trading markets, London and New York. When the Eastern Hemisphere is open, gold seems to drift higher. There might be a few nights in there in the last 6 weeks or 8 weeks, or even going back to August when gold started selling down. There might be a few nights in there where it was red in Asia, but that's to be expected. I mean, when you have real markets that aren't interfered with, you get ups and downs. You don't just get one way for several months like we have had with the stock market.
Or decades.
Right, exactly. or straight down for 7 weeks in a row with gold. I mean, statistically tells you it's either an extreme outlier situation or there's intervention going on.
Yeah, exactly.
I think we all know the answer to that one.
Well, we'll ask Deutsche Bank what their answer is.
So, and then I started looking at some more technical indicators, and I'm just referring to a 1 year daily using the COMEX continuous contract on our RJO trading software that we use for the fund, and the MACD is by far as low as it's been in the last 52 weeks, and I took it back a lot further, and it's actually as low as it's been since I think it was July 2013.
Oh my goodness.
Without having that particular graph in front of me. Yeah. And back then, we had a pretty big move when the MACD got down to this level. Here we go. The MACD is showing its most oversold reading on a daily basis since July 2013. and this is right from my mining stock journal. Although the 5-year gold correction did not run its course yet, obviously, gold bounced from 1180 to 1428 in the next 2 months. So,
Wow.
the last time the MACD was down at this level, we had a pretty large, we had a pretty large bounce. That's about a $248 bounce. So, again, that's another indicator that's screaming buy. Now, what's even more interesting is the RSI indicator. It's another momentum indicator. That thing hit an extreme oversold reading in mid-November, and it's actually been trending higher since mid-November. And what that indicates is that most likely the so-called smart money is buying the sell-offs. So whenever gold dips, smart money comes in and buys, and that foots with what we're seeing in the pattern in the Commitment of Traders report. Even though there's a week and a half lag in it by the time we get to see it, over the last 4 weeks, maybe even 6 weeks, I think for sure 4 weeks, the commercials or the banks have been adding to their long position and covering their massive short position. So they've been, on balance, reducing their net short position.
Okay.
And so that's kind of consistent with what the RSI reading is telling me. And then the last thing I looked at, and this is an indicator that you don't hear about anymore. There used to be a guy who wrote about extensively the gold market. He was a great analyst. I don't know what happened to him. His name was Eric Hommelberg. Maybe any of our listeners have know what happened to him. Between 2000 and 2010, he was quite prolific, and he had an indicator that he used called R Gold, and I guess it's kind of a common market statistical indicator. You take current price of something, so in this case gold, you take the current price of gold and you divide it by the 200-day moving average for gold, and it gives you a ratio. And whenever that ratio gets over 1.1, gold is typically, you want to sell gold or reduce your positions. And when that indicator gets below 1, gold is in a strong buy zone. And I have a chart that he had prepared, and it goes from, I want to say it's not right in front of me, but 2004 to 2008. Let's see if I can find it. And every time that the R Gold indicator got, say, above 1.15, gold would correct or sell off. And every time it went below 1, gold was a buy. And right now, the R Gold indicator is 0.89. Now, I don't know that I can ever remember seeing it that low. It's been kind of in the low 0.9s, but I don't know that I've ever seen it below 0.9. I just found this chart. And so his graph that he plots the R Gold over time goes from February 02 to June of 06. And the lowest in that time period that the R Gold indicator ever got was 0.95. And we're at 0.89 now. So
Wow.
if that indicator still holds any validity, I mean, that's probably your strongest indicator that gold is extraordinarily, if not historically, oversold, at least short term, on a technical basis, and that we're going to get some type of bounce here.
So you don't really see gold getting below 1130 at this point? I mean, because
Well, I don't know.
I'm still seeing people that are saying 1050, 1060 on gold, and I have a hard time believing that it's going to get that low. I mean, I would kind of like to see it that low just so I could acquire some cheaper gold, but it's from what you've just described, Dave. I mean, that R Gold indicator, I like that. I mean, and I'm not familiar with it, but I like the way that works in its simplicity to show either strength or weakness. I mean, and it makes perfect sense.
Yeah. Well, who are these people who are saying gold's going to go to 1050? Here, gold's going to go to 950. Let's publish that. Based on what? I mean, if you go ask the Goldman Sachs commodities strategist, he'll tell you gold's going below 1,000. I mean, he hasn't been right in the whole period of time since he came out and said gold was going to 800. It never got below 1053. Whether or not gold can go below 1130 and have hold there for a day or two, who knows? I mean, you never know what these guys can do with the paper market on a low volume day like Friday, the day before a 3-day Christmas holiday weekend, which is one of the lowest volume days of the year, or Friday, the day before the day before New Year's weekend, which is probably the second lowest volume day of the year. Sure, they could come in Friday mid-morning and just slam the market with paper.
Wouldn't surprise me in the least.
I don't think it's going to stay. And it's so oversold now, and it's so washed out that most, if not all, of the speculative money and little retail trader money that's short-term money, they're mostly likely washed out of it. And it's like Eric was saying to me the other day, it seems like everyone who's left holding long positions in silver says, I don't care what you do to the market, my stop loss is 0. Who cares?
There you
go. So, and when you get to that point, a market is so washed out that there's really not anywhere for it to go except up, even if it's just a short-term technical bounce. So, and what I'm suggesting is we're still in the context of the bull market that started in late 2000, early 2001. And I think that for this 5-year manipulated sell-off that we've had, I think mid-December was the bottom. Now, of course, I could be wrong, just like I'm saying the people saying gold's going to go to 1050 could be wrong. No one knows for sure. But I think that we're going to get a pretty big bounce here, and I think it's going to be accompanied by the dollar topping out and selling off, the yen bottoming out against the dollar, and a whole host of other things, including the fact that I guess there was a report out today in which China said that it's rethinking its treasury holdings, something to that effect. It said China will make tactical adjustments on U.S. debt. And that can only mean one thing based on what they've been doing for the last several months.
Sell more. Sell more.
Right. So, and there's another interesting thing that I picked up on, and there was, Eric King interviews this guy Egon von Greyers. He's the Swiss money manager.
Yes, he is. He's a good one.
And he's probably one of the straightest shooters out there. And he said, and this I thought was extremely interesting. He said that, now, and mind you, he's in Switzerland, so he's going to get better news on the ground than we're going to get over here, where we get everything from the media and it's secondhand. And he said last week, or whenever this interview was posted, that he's hearing reports from Swiss refiners that in recent weeks they have at times had to pay premiums to buy gold due to shortages. And the reason why I think that's interesting is because, as you know, there's been extraordinarily high premiums being paid in China on the Shanghai Gold Exchange. In fact, last night it was like $34 or something.
Yep.
And everyone has trying to explain it. No one can explain it. Not even John Brimlow, who probably has followed the Shanghai Gold Exchange as much as anyone out there, including Coos. And the Western fake news media has been showering the news wires, at least in this sector, with reports that, there's restrictions being put on gold going into China right now because of, the capital outflows, blah, blah, blah. And that's not supported by any of the data that Brimlow reports every day on the Shanghai market.
That just sounds like pure fake news, made up, just pulled out of the air.
That's right. That's right. Because it doesn't fit with the volume of deliveries being reported going into the Shanghai Gold Exchange. That gold has to be coming somewhere, and it doesn't fit with the high premiums. So, and just to go along with that fake news, we kept hearing a lot of fake news about what's going on in India. There was one report on Zero Hedge. The gold market is, they may make gold illegal in India. It's like, well, where did that come from? And as a matter of fact, there's a report out this morning, and it came from a source over in India that said the Indian government may cut the import duty from 10% to 6%.
Yep.
And if that's and I don't think that'll happen. But
No.
that's all of a sudden just the opposite of what we were hearing, for the last few weeks, where all of a sudden they wanted to go knocking door to door on everyone's house and confiscate their gold. I mean, it's all fake news. It's all out there designed to douse the Western public's enthusiasm for precious metals. Now, here's where I think this Swiss Finer report is interesting. To the extent that they have to pay premium for gold that they take in and refine into kilo bars and send back to China through Hong Kong, to the extent that they do that, they're not going to sell their gold at a loss. They have to build that premium that they're paying for their gold into their price.
That doesn't
And
even make sense to me, Dave. I mean, why would a refinery pay a premium to refine gold?
it makes sense if you think about the fact that they're paying $30 an ounce over world gold in China.
Well,
So
yeah.
a refiner is going to be willing to pay, his cost plus the premium plus a profit margin. He's going to be willing to pay above the price of gold to the extent that China's paying above the price of gold. And China may be forced to pay above the price of gold in order for them to get enough gold into the country to satisfy the demand there. They need to if the Swiss refiners have to charge a premium for what they're selling into China, then the Chinese are either going to have to pay it or not buy it. And based on the delivery data going into the Shanghai Gold Exchange, they're still buying a lot of it. So that's why a refiner, look, anyone who's selling a product is going to be willing to incur expenses to the extent that someone's willing to pay for those expenses plus a profit margin, right?
Right.
So if China's willing to pay a high margin to get gold, then the refiners are going to be willing to pay a margin, a premium over spot in order to get gold, so they can keep refining it and keep making a profit.
So that may explain some of that premium that we're seeing on the Shanghai Gold Exchange to world gold, or I should say to the fraudulent COMEX and LBMA pricing. It's just hard for me to wrap my head around a refinery paying a premium, because I think of them taking in other people's gold and refining it and producing it and bringing it to market. But obviously that's not all that they're doing. They're bringing gold to market themselves, and if they're having to pay a premium, then that says a lot about what's going on with the physical gold market. I think that there's just huge demand. I mean, we've seen this has been one of the best years ever for gold in the United States for American Gold Eagles. It's either the first or second best sales year ever. So
I think it's the highest by far, actually.
and that premium on the Shanghai Gold Exchange, that's something that is becoming part of my daily routine, as far as keeping up with it and tracking it a couple of times throughout the day to see how it's moving and what's going on. Something that I'm reporting on every single day, and I think that, and you can correct me or help me to better understand this, Dave, but it seems like that is going to become one of the indicators that says what's actually happening with the physical market. I mean, because this is a price fix, just like the COMEX and LBMA. It is a price fix.
It's always been an indicator of what's going on in the physical market. But what's interesting about it is that, say, for the last 4 or 5 years, whenever the premium in Shanghai was above zero, it meant there was a fair amount of gold going in there. And the highest that I had ever seen it up until this year was maybe high single digits. I don't really recall in the last 5 years ever seeing that premium above $10. Now, that doesn't mean that there might not have been a day or two in there when it spiked over it and I didn't see the data. But I've been monitoring this daily through Brimlow's reports for at least the last 5 years. So anything above a zero premium meant that gold was going in there at a pretty good clip. And now you're seeing premiums that are in the 20s and 30s, and it escalated pretty quickly.
Exactly. I mean, and that's been something that I've really paid attention to and been reporting on, is this escalation, because it went from the low mid-teens to now mid-30s and above. I mean, it actually hit over $50 an ounce for a short period not too long ago. I mean, these are insane numbers, at least to me anyway. I mean, it doesn't make sense, or it does make sense. It's hard to believe that the miners are still taking their product into a fraudulent market. They know it's fraudulent, and they have this other market that's paying a premium to this fraud. And why would you take your product into the COMEX and sell it there when you could take it to Shanghai? I mean, I know we got into this the other day, but it's still, and Chris Powell just ripped into these guys. Chris Powell over at GATA just ripped into the miners, the CEOs, and Eric Dubin ripped into the World Gold Council. I mean, what's the matter with these? Are these guys, are they that scared that they can't voice their opinion, that they can't go to the COMEX and say, hey, what's going on here? We have evidence, we have it proven in a court of law that these markets are rigged, period. What are you doing about it? What are you putting into place to make this stop? I mean, and it doesn't, these guys are going to have to get a backbone. That's all I can say. I mean, you can't.
You know what? Here's the thing, Rory. I mean, GATA has been screaming at the gold miners for as long as I've been following GATA, since 2001. And they've been screaming at the World Gold Council. And the thing is, you got to realize, the large gold miners, Newmont, Gold Corp, Barrick, Anglo Gold, SoT, they don't just sell their gold on the COMEX. They sell their gold on the world market. So that they produce doré bars, and then they sell them to refiners, and then those bars end up on the LBMA or whatever. And what I have found over the years, because I've primarily just covered juniors right now, but I've spoken to several, large cap producing companies over time. These guys, especially the upper management, they don't care about any gold manipulation. A lot of them don't even believe in it. The CEO of Pan American Silver, he'll tell you that the market's not rigged. He doesn't care. These guys just want to get their product out of the ground and get it sold. That's all they care about, because that's what brings the cash flow in. These large companies, and the reason why I don't invest in them or follow them, is they're very poorly managed. They're all poorly managed. And you look at, you take Barrick, for instance. It's always been rumored that they're part of the problem. They're part of the problem with the market. And now you've got a former management committee member at Goldman Sachs who's now the chairman of Barrick. So, I mean, what does that tell you? The large mining companies don't care about whether or not they could get more for their gold. All they care about is that they can sell it for more than it costs them to get it out of the ground. It's a volume game for them. I know it doesn't make sense. It's not a way to run a business, but my guess is also, when you look at who runs these large companies, I mean, these CEOs of mining companies make a lot of money. They make more than your average CEO. And most of them are sort of part of the quote unquote club. And they're not going to come out, they're not going to rattle the chains of the Western establishment by coming out and railing against the system, because obviously the Western governments want the price of gold rigged because it helps them with all their other manipulations and schemes.
And corruption.
Right. I mean, if interest rates were at 8%, where they probably should be right now, you think the U.S. government would be able to sell a lot of treasuries? No, it'd be too expensive for them. So they have to keep interest rates low. Well, the only way to keep interest rates low is to keep the price of gold low. It's Gibson's paradox. And Larry Summers wrote a paper about that in the mid-90s. And he said, if we're going to manipulate, basically, I'm paraphrasing it and reading in between the lines. If we're going to manipulate interest rates, we got to keep the price of gold down. So that's your Larry Summers, who has been economic advisors to presidents. So these guys aren't going to rattle the chain, and it's just, they're part of the club. It's just like Jim Rogers, right? The highly esteemed Jim Rogers. He's comes out and says he's buying silver hand over fist. Occasionally he'll say he's buying gold. He knows the market's rigged, but he's not going to come out and say it because he's part of the club, and he likes being part of the club. And if he were to come out, and start railing against the manipulation, he'd be kicked out of the club.
Well, yet another reason to hate these manipulators and what they're doing to us. It all comes back to our personal freedom, our personal sovereignty, and I will never, as long as I live, I will never forget Aleister MacLeod talking about the people that own gold are typically happier and have a better sense about themselves and where they're at. And if everybody had that, how much better would we be? I don't know. It's Christmas. That's what I know. It's Christmas time. We're staring a new year in the face, and I like that because 2016. Let's get this one behind us.
Well,
get into a new year.
I agree, and I guess if I want to offer up a gift to our listeners, go back and read or reread Alan Greenspan's Gold and Economic Freedom, written, believe it or not, in 1966.
Yep.
The final paragraph. This is the shabby secret of the welfare statist's tirades against gold. Deficit spending is simply a scheme for the confiscation of wealth. Gold stands in the way of this insidious process. It stands as a protector of property rights. If one grasps this, one has no difficulty in understanding the statists' antagonism toward the gold standard.
There you have it.
And that, right. And I mean, the first time I read that was probably 2002, 2003, something like that. It blew me away because if any central banker is emblematic of money printing and a fiat paper economic system, it's Alan Greenspan.
He's the maestro.
He did a complete about face from his real economic views in the 1960s and early 70s, and sold out to the other side.
That's a huge sellout.
Huge.
Jeez.
But this is probably the single best explanation, this whole essay, for why the world needs to be on a gold standard and why the gold standard works better than any other type of object used as monetary backing.
Because there's just enough of it.
Well, I have my own theories on it, but that's for another day.
Well, I guess that's as good a spot as any to wrap up 2016 with the shadow of truth, don't you think, Dave?
I believe it is.
Because this is our last show for the year, and we're taking next week off, and we'll pick it up after the first of the year. Hope everybody stays safe, has a Merry Christmas, Happy Hanukkah, whatever you're celebrating or not celebrating.
What do the Satanists celebrate?
Don't want to know. I don't want to know. Oh. Well, Dave, you want to leave them with anything?
I just want to reiterate what you said. Hope everyone has a happy holiday season, a safe and healthy holiday season. And if you got any extra cash after you do your Christmas spending, go out and buy some silver or gold. It'll make you feel better.
Make you feel a lot better.
That's right.
Well, all right. Well, on that happy note, we will talk with you in 2017.
Sounds good to me.